Thank you, Brian. We will now be pleased to take your questions. Please limit yourself to one question and then rejoin the queue to allow everyone the opportunity to participate in the call. Operator, can we have the first question on the phone, please?
Thank you. The first question is from Ebrahim Poonawala from Bank of America. Please go ahead.
Good morning. I guess maybe the first one question, if we could spend some time on the margin outlook, Raj. One, just talk to us in terms of expectations for consolidated NIM, NII, understanding your hedging program that's been ongoing. And secondly, if you could, both in Canadian and international banking, where do you see the margin going over the next few quarters? And for international, do we need central banks to stop rate hikes before we see the margin expansion in international IB? Just give us a sense of the trajectory of the margin in international. What could be the end state for that segment in terms of the margin? Thank you.
Sure. Thanks, Ibrahim, and good morning, and thanks for the question. Let me just address the modest margin compression of 1 basis point we saw this quarter at the all-bank level, and then I'll get to the two business lines you referenced. I'll point out a few reasons. The rapid increase in administered rates resulted in deposits repricing faster and a move to term deposits, which I referenced in my prepared remarks, both in Canada as well as in the Pacific Alliance countries. Significant increase, as you noticed, both across all the Pacific Alliance countries. Brian referenced the 300 basis points in Colombia, for example. This also results in an increased cost of funds, both deposits and term funding from the wholesale markets. What we've seen is stronger than anticipated growth in lower margin products too. Corporate, commercial, mortgages. That's also impacted what I would call the asset margin. And then asset repricing is ongoing, but it's obviously not kept pace with the changes in deposit repricing. So that's kind of the explanation for the 1 basis point. But looking forward, we expect asset repricing to continue. That should improve the margin in future quarters. I'm talking about all banks now. And the modest margin compression, frankly, is a result of the hedging that you referenced, the benefits that we have at the all-bank level. As you know, we typically hedge the U.S. and CAD and not necessarily the Pacific Alliance interest rates because you don't have the ability to hedge. But specifically to the two business lines you referenced, Canadian margin you saw expanding. A lot of it came from the deposit side. Asset margins are lower, as you would expect in this rising rate environment in the medium term or in the short term, I should say, and start repricing through the medium term, and then we should start seeing asset margin expand in the Canadian bank. The same thing applies to international bank. It's only slightly different in that, the rapid rate of increases have been exponentially high, say, compared to Canada, so you're seeing a bigger impact in the international banking margin. But I go back to the same thing in my prepared remarks, Ibrahim. That margin quickly rebounded from 369 to 386 until last quarter, or 17 basis points. That's the impact we see. And the modest margin compression of 1 basis point is for the same reasons that I quoted, which applies to the all bank. Deposits moving in faster, conversion of what we would call core deposits to term deposits happening pretty quickly in some of the countries in the Pacific Alliance. We should see margin expansion happening through the international banking business line as well. I'm not going to say in Q4 it's going to start expanding. I think Q4 will remain maybe likely stable. But, looking forward into 2023, and we'll speak more in detail in November, we would expect that we should see NIM expansion in the international banking space as well.
Got it. That was helpful. And just, I'm sorry if I missed it. Did you talk about what you expect in terms of just consolidated all-bank NIM for the fourth quarter, or how much of expansion you expect near term?
Yeah, I think it should be fairly stable, Ibrahim, because I think the international bank NIM being stable, cost of funds are not coming down fairly quickly, as we all know, as, central banks are trying to deal with inflation effects. I think the Canadian margin will, I would say modestly expand as deposits margin contribute a little bit more. So I'd say it's likely expected to be in line with what you saw this quarter, maybe a basis point or two, one way or the other.
Got it. I'll DQ. Thank you.
Thanks, Ibrahim.
Thank you. The next question is from Gabriel Dechaine from National Bank Financial. Please go ahead.
Good morning. I just have a question on the deposit substitution effect. Sounds like you're seeing it more in the international segment, switching from zero cost to term deposit. Is there any chance we start to see that in a more accelerated fashion in Canada? And then just a quick one on the client activity comment in GBM. I get that characterization. I just wonder if you can put maybe frame it with a few numbers, and more importantly, are you starting to see that reverse in the current quarter? Thanks.
Sure, Gabe, I'll start, and I'm sure Dan might have other stuff to say or not so specific to their business. This conversion, if I can call it that, between core to term is actually happening in the Canadian bank too.
Okay.
It's just that the deposit base is significantly larger, so it's not actually showing up as big as it's showing up in the international banking space. That's the short version of the answer. Specific numbers, we've seen already about $4 billion move from core to term deposits, and in international banking, it's been about $1 billion. But relatively speaking, we're seeing similar trends in both businesses, and that I think is expected to continue until central bank rate increases stop, I would say, in the international banking space specifically. And Jake, do you want to take the question on the GBM?
For sure. Thanks, Raj. And Gabe, thanks for your question. To give you some dimensions or framing around it, I'll talk about Canada and the U.S. We've seen a decline in ECM issuance north of 80% in both of those markets, and those are our two largest markets. After that, on the debt capital market side, you've seen issuance decline north of 60% in the quarter in those same two markets, Canada and the U.S. And to further frame that out, that's the lowest issuance levels we've seen in these markets at any point in the past 5 years. And so that's important because it obviously impacts some of the fee lines, but those new issues also then contribute to activating the capital markets, whether it's secondary trading, whether it's hedging activity, et cetera. So it does have a material impact in the quarter. In terms of outlook, we have already started to see it rebound. It's still early in Q4. We're only a few weeks in, but we're seeing our ECM business at a stronger level than where we were throughout all of Q3. So there are some signs of the rebound happening, including in ECM and DCM in those key markets in Canada and the U.S., so we're favorably disposed as we work through Q4 here. Hope that answers it.
Yeah, I was thinking more, I mean, the ECM, DCM activity, we've all seen that. I was thinking more along the lines of whether it's prime brokerage or some of the other business lines we don't see as clearly, and, declines in margin loan, stuff like that. But I guess it's probably along the same line.
Sure. Well, happy to add some coloring around that too. So during the quarter, you obviously saw VIX shoot up. You saw equity indices be quite volatile and come down. And with that, we also saw cost of funds, as Raj alluded to, move up. And so you had two effects happening. Spreads narrowing on financing businesses and in trading margins. And at the same time, you would have seen clients degrossing their exposure to a downward pressured market. And so that would have taken trading assets and trading securities down in the quarter, which you would have seen. But we've been thoughtful around our balance sheet construction. So as that's come down, and as clients have not been accessing the primary market, whether it's debt or equity, we've been able to grow our loan side of the balance sheet and support our client growth there. And so you've seen continued strong loan growth in our focus markets like the U.S. and Canada, and you've seen continued good deposit growth to fund that at the end of the day. So definitely see reduction in trading activities as clients, both corporate and institutional, move to the sideline. Also saw it in financing businesses as well as spreads got more narrow and as clients degross their investment portfolios.
Thanks, and enjoy the rest of your summer.
Thanks, Gabe.
Thank you. The next question is from John Aiken from Barclays. Please go ahead.
Good morning, Jake. If you can stay on the microphone for a second. I understand the impact on trading from the ECM, the DCM, but I was a little bit surprised to see the downdraft in the FX trading specifically. Is this just a spillover impact on the FX trading from what you saw in the markets, or were there actually trading losses generated? Like I noticed there were two days of trading losses during the quarter. Was that specifically ascribed to FX, or is this just client volumes were down and you just weren't able to generate the same amount of trade?
Hey, John, I'll start. It's Raj, and then I'll pass it on to Jake for additional color specific to FX. What you're referencing is what we categorize as FX and other, I think in the trading-related subpart page. And I think the key is the other over there. FX has been actually fairly good when you look at it quarter-over-quarter or year-over-year, so that's not the contributor. Commodities goes into it, and we have a lot of what I would call other derivative-related trading activities, and a lot of it is hedged for the interest rate products that we have, which goes through NII in the GBM LATAM business, which is in international banking. That's where you're seeing the year-over-year. And some component of it relates to last year, as you know, we had some opportunities both in Peru and in one other country in the Latin American space. Because of political turmoil, we had opportunities to actually monetize some sort of trading revenues. That's what you're not seeing this quarter compared to Q3 of 2021. So there's not much there relating to FX specifically, but there are various other, what I would call trading-related activities that go under that line. And it tends to be not as volatile as what you've seen this quarter, but you could see from time to time moments in that line. Jake, do you want to add some color on FX?
Yeah, I think you've answered that question well. And John, we're not seeing any real material change in the current period around client FX activity. As Raj noted, it was a bit elevated back in Q3 last year due to some good conditions we saw, particularly in the GBM LATAM piece of the business. And with specific request to your comment around that, we did have 2 trading loss days in the quarter. Those, nothing material, nothing broken there, and not ascribed to any bad FX trades in any way, just weaker market days for the platform.
Great. Thanks for the color. I'll requeue.
Thank you. The next question is from Scott Chan from Canaccord Genuity. Please go ahead.
Good morning. Maybe for Phil on credit. Thanks for the incremental data points that you talked about on the call. Is there anything that's maybe changed in terms of your prior fiscal 2023 total PCL target ratio in the mid-30s intra-quarter? I'm just trying to assess quarter-over-quarter what happened with inflation, everything like that. If it incrementally or materially changed your outlook there.
Thanks for the question, Scott. I appreciate it. We're not going to. I won't restate guidance for 23 now, but I'll give you some indicators of what we're seeing in our portfolios that may be helpful to you. I think, first off, if I start to compare our current portfolio to pre-pandemic, we're running somewhere in the lines of half of our delinquency rates, half of our net write-off rates. Big move to secured lending away from unsecured lending. The other thing, if you look at our international footprint, we've really repositioned in terms of the quality of originations there. In addition to, we'll have the sale of Credit Scotia, our Peruvian consumer finance portfolio that will be coming through into in October this year. So that will also represent a bit of a tailwind from a PCL perspective for us heading into next year. But we're seeing both in our international platform and our Canadian platform, really healthy consumers. Even in IB, when we mine and look at how our deposit account customers or payroll account customers are performing, they're still holding liquidity in their accounts versus pre-pandemic, and we're seeing that same sort of trend in Canada. So we're not seeing any big credit headwinds on the horizon. And if I could just reiterate, health of consumers continues to be very, very strong, and all the sort of credit key risk indicators continue to be positive.
If I could sneak a quick one for Raj, slide 24 in your investor presentation, the rate sensitivity. I've noticed over the past couple of quarters, 100 parallel shift upwards would negatively impact your NII, which is contrary to peers. Is it all hedging, or is there some other aspects that make that sensitivity that way?
Yeah, I think it's a good question, Scott. I think you're referring to the 100 basis point sensitivity, right, which increased from the 126 to 267 million this quarter. So you're absolutely right. I think, as I mentioned before, this table captures the impact of a parallel shift, so I won't repeat all that stuff. But what I will say is, as rates have gone up, we know that certainly did not happen. So short end went up, long end did not move, frankly. So our view on hedging remains the same. Short-term rates went up, term rates remain the same. Anticipated additional central bank rate hikes have already been what we think is priced into the rate curve, the medium term, whether it's 3 years, 5 years, however you look at it. What we started doing in Q4 21, Scott, is we started capturing the benefit from higher term rates that the market is already indicating by cautiously extending what we call the bank's balance sheet duration. Not all of it, some portion of it. That's what resulted in lower NII sensitivity. So every time you extend duration, the sensitivity is going to go down, as you would expect. It's already captured in the net interest income line, what we report quarter after quarter. So that's what you're seeing. We do believe that we are positioned appropriately, And it's being reflected, like I talked a little bit earlier about why our NIM compressed only 1 basis point. The benefit of the hedging activity offsets some of what we expect as deposit rates going up significantly. So that's what you're seeing, and we'll continue to extend duration thoughtfully as we look at the rate curve as well as the construct of our balance sheet and how our balance sheet is evolving, be it on the asset side or on the deposit side.
Okay, that's helpful. Thank you very much.
Thanks.
Thank you. The next question is from Mario Mendonca from TD Securities. Please go ahead.
Good morning. Raj, if we could go back to the international segment, specifically Pacific Alliance. So last quarter, the margin was up 9 basis points. This quarter, down 20 basis points. I'm trying to understand that type of volatility over a 2-quarter period. Is it all sort of deposit activity and deposit behavior, or was there something else going on in that segment related to, as you just mentioned, extending duration? Is there anything else going on besides just depositor behavior?
Yeah, I'll answer the second part first, which is extending duration, Mario. Our extension of duration is generally focused only on CAD and US because that's where we have the ability to hedge derivatives and all that stuff. I'll pass it on to Nacho to speak specifically about what he's seeing in the Pacific Alliance countries relating to the margin compression this quarter compared to the expansion he saw in 2 quarters.
Yes, sure. Good morning, Mario. Listen, I think like Raj mentioned earlier, this volatility in our NIM is driven by very steep increases in central bank interest rates. Just in the last quarter, it was 2.5% on average in the Pacific Alliance countries, 4% increase in Colombia, 2.75 in Chile, 2% in Peru. So what you are seeing really deposit repricing happening faster than asset repricing. However, as you mentioned, the first 2 quarters, if you take not only the second quarter, but the first 2 quarters, Pacific Alliance countries expanded margin by 20 bips that we gave up this quarter. We expect, as Raj mentioned, this margin compression to be temporary because we are repricing our assets, and as soon as interest rates stabilize and then turn downwards, we will see margin expansion. Central banks in the region have proactively raised rates in advance of the Fed, and as a result, inflation appears to have peaked in Peru and soon in the other 3 countries. In fact, the 4 countries are one of the few which already have positive real interest rates adjusted by 2023 forward-looking inflation. So if you combine this trend with very strong asset growth, we are seeing in the Pacific Alliance countries 16% expansion of our loan book year over year, 4% in the quarter, 4% in retail, 5% in commercial. So eventually, this trend will be positive to revenue growth when we see stability in our cost of funds and then a downward trend.
Okay, Nacho, could you talk then about the average duration of the loan book and maybe the earning asset book in international banking generally, and maybe Pacific Alliance as well?
Sure, I'll start, Mario. I think one of the nuances we have, which is a positive, specifically in the commercial side of the international banking book, repricing happens every quarter, typically, right? Every 3 months you have the ability to reprice. You can price to win, you can price to not win. So we have a lot of flexibility there. The average duration will be 1 to 1.5 years if you want to look across the portfolio, be it on the retail side or on the commercial lending side. But it's important to remember our commercial book is actually bigger than our retail book in international banking, just by size. It's almost $80 billion, while the retail book tends to be between 65 to 70, depending on the quarter that it goes. So I think the ability to reprice is fairly quick on the commercial book side, on that side. And when it gets to the retail side of the book, we have a lot of mortgages and so on, which is, increasing the duration a little bit, but still well within the 2-year mark.
Okay, so it sounds to me, Raj, not to put words in your mouth, but we could see that as early as the first half of 23, some margin expansion then.
Definitely. I think to expand a little bit on what Nacho said, what we saw in the first 2 quarters, Mario, was asset margin expansion in IB. What is offsetting now is the deposit margins, which is under pressure in the IB world because of the steep increase in rates. So as asset margins start to come back, which we do expect, I think your hypothesis is correct.
Thank you.
Thank you. The next question is from Lamar Persad from Cormark Securities. Please go ahead.
Thanks. Maybe for Raj, I appreciate that you already provided outlook on margins at the all bank level, but I'm wondering if you could just talk a little bit about the divergence of the margin performance at the all bank level versus the retail segments broadly. Like Canadian banking margins up 7 basis points sequentially, international down 1 basis point. Now, while I can appreciate that that isn't the all bank, that doesn't make up the all bank NII. It does make up a bulk of it, the bulk of it. So could we see this dynamic playing out that is, kind of good margin performance in the retail segments, but all bank margins continue to move lower, or is it just something unique this quarter that weighed at the all bank level?
Hey, Lamar, thank you for the question. And I'll take your last sentence as yes, it is something unique this quarter. I'll speak a little bit about how it works between, like you said, the corporate segment and, say, the Canadian bank, which is the easy one to talk about. As you know, transfer pricing works on both the deposit side and the asset side. So what you saw this quarter is when deposits start repricing quickly, mechanically we pay the Canadian bank from the corporate segment and we charge them for the asset side. So as we look forward, as asset margins start expanding in the Canadian bank as well, you'll see the offset coming. So which means the Canadian bank should be flat, should not be a headwind to the Canadian bank margin, but you would see the pickup at the all bank level. Now, how soon that will happen, it depends on how soon asset margins start expanding, which is already happening, but you should see the exponential component over the next couple of quarters. Shouldn't impact the Canadian banking margin, to be clear, will help the all bank margin stabilize.
Okay, I appreciate that. And then if I could squeeze another one in, maybe for Dan, I'm just wondering if you could drill down into what drove the strong business loan growth this quarter. Was it market share gains? Maybe talk to what provinces and industries this growth came from, and then was it to one or two chunky loans, and then maybe offer an outlook for Q3. I guess where I'm going with this is I'm wondering if any borrowers are starting to show signs of hesitation given the challenging macroeconomic environment. Thanks.
Yeah, thank you, Lamar. It's Dan here. Look, I think our strategic emphasis on growing our market position in business banking played out again this quarter. You're perhaps referring to loan growth, but we're very pleased with the deposit growth, including sequentially in commercial. That's important because this segment self-funds more deposits and loans. And so, as Raj mentioned, we're expecting to see our ongoing emphasis on deposits in commercial continue into Q4. We're undersized in this segment. Our investments and the core operating performance of the teams is what's driving the growth rate. I think if you adjust for our starting position, meaning the smallest of the big five, our growth rate looks more in line. Thank you for calling out the provinces. As I've said many times, we have particular opportunity in British Columbia and Quebec. They are growing above the national growth rate, both in loans and deposits. So we're pleased with the dynamics there. And to reemphasize, we are not. Our credit appetite remains consistent. We've invested in expanding our sales teams and providing them with better technologies, and that's what's contributing to steady market share gains, whether it's in those provinces or in important industries like agriculture, transportation, real estate, technology, and distribution. So the balance of growth in the last couple of quarters has been more balanced than previous. A year or two ago, we would have been calling out real estate exposure as a main driver. That's now much more balanced, which you can imagine we're pleased about. In terms of outlook, we're not seeing any hesitance from commercial borrowers to continue to invest in their business. We're not seeing any pressure on utilization rates. Credit migration has actually been improving. And so the tone from the majority of our customers has been medium-term orientation, invest in capital equipment, land and people, and they're struggling to find product and they're struggling to find people, and they're investing in the assumption that the economic outlook will be good over the medium term. So our emphasis there will continue, and as will our emphasis on deposits.
Great, thanks.
Thank you. The next question is from Doug Young from Desjardins Capital Markets. Please go ahead.
Good morning. Hopefully this is a quick one. Just on international banking, when I think back over the last year, you put through cost reductions, you picked up an extra stake in Chile this year, and I get that FX headwinds have been pressure and the capital market discussion as well, but I figured we'd start to see more sequential growth in pre-tax, pre-provision earnings. And I guess my question is that a realistic expectation as we go into Q4 or into next year? You've talked a bit about NIMs and what your expectations are, but maybe just kind of backing up, taking it to the big picture level. Is that a realistic expectation, or are the headwinds still really too big at this point?
No, I think it's a realistic expectation. Actually, we saw revenues growing up 2% Q over Q despite the NIM being relatively flat. And we are seeing very good business growth momentum both in commercial and retail. So we expect this loan and deposit growth to continue. As you mentioned, we have been managing very well our expenses. Our expenses are flat year over year, despite high inflation of average 10% in the countries. And this is driven by very strong digital progress and timely execution of all efficiency gains that we committed with the restructuring charge last year. So our operating leverage year to date is 250 bips. So looking forward, I expect this good momentum in loans and deposits to continue, translating into revenue growth with some volatility, as we have explained today, driven by central bank interest rate movements and market-related revenues. And we also expect positive operating leverage and good expense management to continue.
I'm just going to add something to that. It's Brian, and I think Nacho answered the question exceedingly well. I just focus on the macro picture. Asset growth is going to continue. The demand for credit is strong. We have significant pipelines on the corporate, commercial, and retail businesses. And then, as we answered earlier, asset repricing is happening now and will continue through the balance of fiscal 23. And, I'm not going to forecast rates, but we've commented rates in the last quarter were up 400 basis points in Colombia, 275 basis points in Chile. The base rate in Peru's gone from 25 basis points to 725 in the last 9 months, to give you some idea of how rates have increased and how dramatic they're. But rates are peaking. And it's a question whether there's one more or central banks are done. So that positions us very well in terms of the asset growth pipelines and the margin in our business.
I appreciate it. Maybe just one quick one for Raj. I think you talked about targeting positive all-bank operating leverage in fiscal 22. You're negative year-to-date with 1 quarter left to go. Do you still think you can show positive operating leverage for this year?
Let me give you a little more elaborate answer than that. I think 3 of our business lines are expected to deliver positive operating leverage. This will be Canadian international banking as well as wealth management. GBM is coming off 2 strong years, will not, primarily due to lower trading and advisory revenue that is unfortunately impacted by the lack of client activity. I don't think that's going to correct itself as quickly in Q4. What that will likely result for the bank, the operating leverage will be slightly negative. I think it's 0.9% negative this quarter, year to date. I believe it will be that. But what I do want to point out is we're meeting all our other medium-term objectives like, ROE, EPS growth, and of course, strong capital ratios.
Good. Thank you.
Thank you. The next question is from Sohrab Movahedi from BMO Capital Markets. Please go ahead.
Thank you. Wanted to just go to Dan. Dan, your segment has had double-digit pre-tax, pre-provision growth for a number of quarters now. I don't want to say is this as good as it gets, but what's your outlook here for your pre-tax, pre-provision? And the flip side of the question, I guess, broader question for Brian. The international segment is back for second quarter in a row now, 600 million plus in earnings. But I think it's still only around 25% of the total bank when you have depressed kind of GBM results, resilient wealth results, but presumably GBM and wealth will kind of rebound. Trying to kind of get a feel for how much of the total bank is international going to be, once you have some I'll call it mean reversion in some of the other segments. Keeping in mind that probably Canadian banking is going to moderate from here, or that compounds the felony, depending on how Dan answers the question, I suppose.
Thank you, Sohrab. Obviously, we're pleased with double-digit PTPP growth rates, and for a little while now. That is outsized in terms of the long-run performance of this segment in general in the industry, so some normalization would be a reasonable expectation. We're certainly pleased to have published 7 quarters of positive operating leverage. You've noticed for a while now we're hovering around 44% productivity ratio, so much of our confidence in PTPP going forward rests on the production and productivity of the sales and the digital teams. And I think notwithstanding the fact that there are some views that the economy could slow dramatically from here, our belief is that the performance of the segment, the way that the system is better fit together, gives us confidence that we'll outperform on a peer basis in terms of PTPP growth rate over the medium term, including into next year. In terms of projecting levels, I think the team here would prefer to leave outlook for next year to next quarter, and I'll pass it to Brian for his comments.
Yeah, thank you for the question, Sohrab. Just a comment on international, which I think is important, is that, and sometimes it gets buried in the detail, but Raj did mention in his comments, GBM LATAM produced profit of $192 million this quarter, I think the second highest on record. That business continues to do exceedingly well. And we have bright prospects for that business. And as I said earlier to another question, a great pipeline of business there. The international wealth results were up this quarter, and we see good growth trends in that business. So the international business is in its entirety, and I'm really pleased with the results out of the division this quarter because, as I said, this was given the rapid and rate increases that we've seen and the impact on the liability side of the balance sheet and how we responded with our customers. I'm very pleased with the results. So, and we will benefit from asset repricing in subsequent quarters, and we're starting to see that already. So the international business, and the last point I'd make is the Caribbean results this quarter were very strong. We haven't seen that for a while, and it shows you the diversification benefit of our business as tourism has picked up, and we expect a strong 2023 for our Caribbean business. So international, the outlook for international is very strong and bright indeed, and we look forward to continued improving results.
Okay, I appreciate it. Can I just do one quick follow-up with Dan? And if push came to shove, what sort of, where can you get operating leverage? Do you have room on your expenses, or if revenue growth slowed down, could we be faced with negative operating leverage?
Look, I think margin has a big impact, right? NII is such a big piece of the line. I think we've said on a few prior quarters, Sohrab, that we haven't seen the full pickup yet compared to pre-pandemic in credit cards. In automotive, and those two books combined represent a significant portion of total revenues. We've been producing substantial operating leverage for a long time now in the business bank, so the larger that share becomes of the total makes a big difference. And obviously, Tangerine is a beneficiary of a deposit growing environment. And so, I think our ambition is to continue to print positive operating leverage on a quarterly basis, but certainly on a full year basis this year and into next year, regardless of what happens with expenses.
I appreciate that. Thank you.
Okay, on behalf of the entire management team, I want to thank everyone for participating in our call today. I know we went a little bit over. I look forward to speaking with you again at our Q4 2022 call in November. Have a great day.
Thank you.